Everybody is focused on sourcing better and investing better. Nobody is focused on adding value. And that is exactly where everything goes right or wrong. When you give seed capital to a small company and they are able to mobilize a tremendous amount of capital afterwards, you create lasting impact that is almost its own flywheel of impact. And that is why that fund indirectly impacts 83 million people. We've put together a 38 to 40 question questionnaire. Every founder needs to complete it before we invest. And we're in the process of algorithmically understanding some of the trends. We also do behavioral assessments to understand who the right relationship manager is for any portfolio company at any given time when we invest. I wish I had been bolder about following my intuition that there need to not be a trade-off, but I got caught in a narrative that impact and returns can't go hand in hand, and it's just not true.
Over 83% of you that listen to or watch this show regularly haven't yet subscribed to this show. So could I ask you for a favor before we start today? If you like the show and if you like what we do here and you want to support us, the free and simple way that you can do just that is by hitting the subscribe button or following us on your podcast app. It helps this channel more than you know. Thank you and enjoy this episode. Eva, thanks for being here today.
Thank you, Scott, for having me. It's a pleasure to be on the show.
I want to start with your origin story. You were born in the New York City area and raised primarily on Staten Island. There's something poetic about the fact that you could literally see Wall Street across the Hudson River from where you grew up. So tell me a little bit about your childhood environment. And I'm particularly curious about how you grew up in a household where both of your parents were working artists and how that might have influenced you, and maybe in hindsight, how that environment may have shaped who you eventually became today.
I think if you were to ask me right now, what are the qualities that I admire in myself, one of them would be creativity. And that 100% came from my upbringing. I grew up in Staten Island, as we like to say in New York. Staten Island is a borough of New York City, and it is typically where the kind of blue collar workers live. Firemen, secretaries, a lot of Wall Street traders. But to your point, it was poetic that I did grow up about an 8-minute walk from the Staten Island ferry with a beautiful view of downtown Manhattan, but really separated. And I think I was separated in a couple ways. The language of money was not really a part of my day-to-day. My parents are middle class teachers, doing quite well, really set themselves up well in retirement. There's, of course, a discipline, but the actual language of money, of the kind of finance talk or business talk or talking about stocks and investing, that was not a part of my world. Growing up in that environment, I was so curious because I was raised in a curious environment. Artists are inherently curious. They're always thinking about what else can I use? What materials can I use to create? How can I collaborate with others? How can I express myself differently? That was 100% something that was modeled for me. And I was an only child. So the entire focus of my upbringing was on me and the art. I got to benefit from that. And as you asked, Scott, how did that translate to what I do now? Believe it or not, it made me an entrepreneur. I know others who were raised in families of entrepreneurs and that was just kind of normal. And then they became entrepreneurs. For me, led me to think so far out of the box and to see the future in such a different way because of that creative element that I was able to generate ideas. And then with my later education, learn the skills of executing on them.
What kind of artists were they?
My dad's a sculptor and my mom's a painter. So different.
Like an oil painter or visual artist? Or
She's worked in many different media over the years, whether it's oil paint or even ink on paper. She's done a series of all 50 states. There's a political undertone to my family, or, potentially a kind of American undertone to my family. Some of our family members having worked in the US government. She's done works with all 50 states. on ink on paper. And my dad has a very specific method for constructing more organic forms from wood and metal.
I can understand that gave you an entree into the world of entrepreneurship because there are no jobs advertised on any job boards for artists, right? An artist is the very essence of entrepreneurs. So that's an interesting observation. Now, there's a early generational connection for you to Africa in your family. Your father grew up in Tanzania. Your grandfather was from the Midwest, but moved the family to Tanzania in 1959. So tell me about that story and how did that impact your father and then ultimately you?
Like you, Scott, we're from the Midwest. My parents only moved to New York for the art world, but my parents are both born in the Midwest. My mother in Michigan, my father in Oklahoma when his dad was in medical school. Unfortunately, both of my parents lost their mothers when they were very young. But in my father's case, my grandfather was left with 5 children. And so what ended up happening was he remarried a very adventurous woman, and they came home one day and they told either 5 or 6 children at that point, we're going to either go to Latin America, we're going to go to Africa, or we're going to go to India. And your dad is going to work as a doctor, and we're going to leverage our Catholic missionary connections to just have community around us. We won't be missionaries, but we will leverage that network. So they ended up finding a connection in the western part of Tanzania near a city called Mbeya, like a second tier city. And they took a steamship from New York City down to Cape Town and drove an airstream up to Tanzania and established life and lived there for over 15 years. There were actually 9 when they came back. So 3 more plus 1 adopted. A number of them were born in Africa and born in Tanzania. So it was a really important part of what I learned when I grew up, because I could tell that it was a really important part of my father's life, having that experience. The stories that he tells me are incredible, not only of living there, but then traveling back and forth as a young boy, often through Rome to see the Pope. Every time I hear about his time living in Africa, I felt warmth, fondness, and a longing for connection with the greater world. And that just became instilled in me. When the financial crisis happened, I was working on Wall Street. I was sitting in front of a Bloomberg terminal, was in the thick of what are hedge funds investing in day in and day out. And I just thought, this big short trade thing, it's not for me. It's not sustainable to invest this way. So let me go find a way to invest that is more sustainable. And as the hedge fund managers like to say, and I know you have a lot of institutional capital in your network, I took a contrarian bet on the future of global growth and started Beyond Capital. So that the through line of the childhood stories to my aha moment on Wall Street was very much so informed by my father living in Tanzania and their family growing up there.
I suppose he had stories of service and social justice, and growing up in an environment with your grandfather of someone willing to take massive risks for a greater purpose. Did that hone out this other dimension of you, understanding what's possible with a career and with life?
My family lived in Tanzania partially during British rule. Modern day UK, I have a lot of admiration for it. My children and husband are British, but I think everybody understands what happened in the past was wrong. And when the family came back to the US during the civil rights movement, they were even more social justice focused because they had already seen the movie. They'd already seen it play out in Africa, and they knew where it was heading. And so social justice became a really important fabric of both sides of my family as I grew up, but certainly shaped my mindset. And as I was growing up, again, being an only child, I was kind of like the little adult in the family. I was included in conversations around social justice or human rights or who gets included and who doesn't get included in conversations. And growing up in New York City, you just have a greater awareness of what the world looks like because New York City is your own little microcosm of every place represented in immigrant communities. And you see how hard everybody works to make it. And so the answer is absolutely. My mindset around investing was formed through my early childhood experiences. And I like to kind of say, you almost can't think your way through things that you learned before you couldn't think. And I believe that some of my patterns and beliefs were certainly formed early on from understanding my family's history and legacy. And it's a pleasure and a privilege and gives me a tremendous amount of energy to carry that forward.
You attended the Curtis High School on Staten Island. Did I get that right? From 1998 to 2002. You've listed that on your LinkedIn profile. I don't know the school, but did that have a particular impact on you?
I'm really glad you asked that question because the answer is a resounding yes. I actually went to all girls Catholic school for 9 years. And then because I was interested in theater, I went to the local public school, which had an exceptional theater program. In doing that, I was able to be in an environment that was very different than my upbringing. In my upbringing, we were always 30 girls in a classroom. Obviously, there was a school fee, so it was a kind of a barrier to entry. Not much diversity at all. Growing up in Staten Island, everybody had an O or an A at the end of their last name because they were Italian or they were Irish. But to share about the experience in high school, I really saw what real America looked like. My parents were middle class, but my parents were really smart. They always had a AAA credit rating. They never missed a payment. They never took on more than they could. They put me through college by second mortgaging their home, which they owned and had built up over time and renovated themselves. They were really self-made in that sense, but I got to see what it was like for people who didn't have that privilege. When you look at the trajectory of individuals who come from different backgrounds and even the micro decisions around how their life is determined by factors unrelated to themselves. Perfect example. We started our graduating class with, I can't remember, but I can tell you that not everybody graduated. When I walked into the office of career development, I had a big wake up call that there were probably a lot of kids in the school who could get into Barnard too, but they couldn't afford it. And so I learned a lot about what it was like for somebody who maybe didn't have a privileged background, which again reinforced this thinking around why, my own personal why as well.
In 2002, you made the decision to study mathematics at Barnard College, which is part of Columbia University. Why did you choose Barnard specifically, and what drew you to study mathematics?
I was very familiar with the all-female environment. I was very comfortable in the all-female environment. I actually was working for a couple where the wife went to Barnard and the husband went to Columbia, and they encouraged me to apply. I would say one of the themes of growing up in Staten Island is sometimes you don't know your worth. I wasn't that aware of where I could go for college. I actually didn't have Ivy Leagues on my list, and they encouraged me to apply and I was accepted. The reason I studied math was honestly because I couldn't handle pre-med as a major. The environment at Columbia University, Barnard, which are effectively the same school, just next to each other and have certain elements of overlap, was way more competitive than I had ever been in. And it was interesting to me because I knew myself so well to know that the all-night organic chemistry studying expectations were not for me. I was not prepped for that. I did not go to prep school. And so I decided to follow my intuition. Math was a place where I had skills, where I had aptitude, and decided to study math as a result of some of the quantitative requirements for pre-med, and basically just took a right turn and said, okay, I've already done these classes. I have to do calc. I have to do all these prerequisites. I'm going to take this further. I would tell you that at Barnard, the benefit of all female education and kind of environments that promote gender equality, empowerment, is my advisor was really encouraging. So while I would walk into the Columbia University math building and talk to all the Russian TAs who would just tell me, it's trivial, figure it out, it's trivial. My advisor at Barnard, my math advisor, encouraged me actually to do a PhD. He was like, you are capable enough to do a PhD, which made me have a lot of self-confidence when I use my math skills on Wall Street and set me up for this kind of quantitative pattern recognition underpinning in my career.
Did you have the idea to follow your grandfather into pre-med? Was there this idea in the back of your mind you were going to go out and heal the world?
No, No, I actually wanted to do medical research. I was called biology girl in high school. You know how creativity and science and math can sometimes go hand in hand? My father falls in that category. He always just instilled in me a curiosity around things that went beyond art and visual art. And one of them was how the body works. To this day, I think mitochondria are the coolest part of our body, and certainly the coolest part of a cell. I really was curious about medicine. I wanted to do medical research and spend my life in a lab, which I'm not sure would have been super fulfilling in the end, knowing how relational I am.
None of us would go to an 18-year-old career counselor. So it's funny how we're all pushed in that position. You're supposed to start university knowing what you want to do with your life. So you've kind of talked about developing your math brain during this time at Barnard, but you also fell coincidentally into finance through a night investment banking program at Merrill Lynch while you were still at Columbia. Tell me about how that experience came about, and then at what point did you realize that traditional investment banking wasn't the right path for you?
It was like a real blessing in disguise. I received a call from a friend who was at Barnard. She's a partner at a VC as well these days. Her boyfriend worked at Merrill in the analyst program. And she said, listen, they're hiring night investment banking analysts after school. You show up in their office in Battery Park downtown. You do some work from 5 or 6 to like midnight or 11, and some people 4 a.m. Luckily, I wasn't in those groups. Then you have dinner, you get your dinner provided, and then they send you home in a black cab. And so I was like, this pays more than my work study in the biology lab. So I'm going to just make the switch, be a little entrepreneurial here. It was really interesting. I had never been in a professional environment like that before. I didn't even know what to do. And I learned, this is where my upbringing like checked me a little bit. There were NYU Stern undergrads, which is the undergraduate business program, who knew how to do discounted cash flow models and had many more skills than I did. And I did have to interview for this role. So I was accepted.
You had to do more than just steam up a mirror.
I certainly had to do PowerPoint and research and print out the documents and then synthesize them. So I learned a lot of the skills of what a banker did. And especially in the early stages, I was shocked that there was just a lot of basic work and it was not interesting or appealing to me. Now, I understand why people do banking. It's like why they do consulting. You gain a pretty broad awareness of different industries. You learn a lot, or maybe you go deep into one industry and then you can kind of work in that industry more easily. But I didn't have that foresight. I was very focused on the feeling in the now. And I was sitting in a room with no windows and people were kind of aggressive. Nobody seemed really happy. And it just wasn't the right place for me.
You didn't stumble into the accounting department?
No, I did not. I happened to be raising money for something. And I asked a contact of mine to put me in touch with one of the kind of top fundraisers in New York in that area. And I called him, and that was also a fun wake up call because he was like, how much do you want to raise? And I was like, whoa, I didn't expect you to ask that question. But he ended up running a fund of hedge funds, and his name is Greg Heimowitz. And a couple months later, I said, listen, I'm in this night investment banking program. I have the skills. Do you need an intern? And he said, yes. And so I walked into the bullpen at Merrill Lynch and I told all of the analysts, hey guys, I'm going to go work for a hedge fund. And they were like, what? How, we want to do that. How did you get that? It was really interesting to move in that direction.
Is this hedge fund Entrust? Is that
Correct,
right?
Correct.
Okay. Before we jump into that, I just want to make sure this night course or whatever, it's not actually a course. They're actually like hiring people to do shit work in the off hours, right?
It was an on-ramp to their analyst program. So they thought, we're in New York. There are a bunch of good schools here. Let's pay whatever it was per hour, allow these individuals to gain experience. And then if they want to stay on, we'll give them fast track into the analyst pool.
You're learning
what it's like to work in a bank.
But also you're getting skills. I suppose there's people who do know what they're doing there and showing you do the model this way or that way.
They threw us in and there was a little sink or swim. But that is finance. There's another person who wants to take your job and you have to prove yourself, right?
I'm not sure I ever heard of this. Is that still happen to this day? I've been in finance almost all my life. And I'm just not aware that they were actually hiring people for like night shifts and then paying them.
Maybe it's happening. I'm not entirely sure, but it sounds stranger than it was. I think the only thing that it takes away from, I can't remember what days I was working, is typically your afternoons and evenings are when you're studying. You have to manage your course load because math is very objective. It's not subjective. So what it brought me was the counterpart to a major, which was like, it's right or it's wrong. There was no way for me to make up an essay. I had friends who were like, I'll just write that essay. It'll be great. There's no way to do that in a math major. And so this was kind of nice because it was a counterbalance, which made me realize, okay, what's next for this for me? And really put me on a good trajectory to become who I am today.
Maybe the difference is back then they hired a night shift and today they just expect college graduates to work day and night. Right, so you got out of Barnard in 2006 and then you went full time at Entrust, which you were already there as an intern. Somewhere I found that you were employee number 2.
Yeah, on the fund of funds. I mean, we had back office, but I was investment team employee number 2.
So this was essentially a startup hedge fund, or were they running money already?
We had 200 million under management when I started, and we built the business to 5 billion in 5 years. When I left, it scaled quite materially from there.
Walk me through exactly what were you doing there, because you were there over 5 years. And if it was 200 million AUM when you got in there, it was around 5 billion by the time you got done.
I was an analyst. I was focused on hedge fund selection, hedge fund analysis, due diligence. I also built our first model for the fund model for us to be able to understand where we were exposed, for lack of a better term. That was the phrasing, was our exposures in the portfolio. And we also did pretty extensive investment monitoring. So every month we produced something called a flash report, where as a team, we would be relationship managers with each hedge fund and we would write about their performance on a monthly basis and send it out to all of our investors. So what I learned was deep due diligence. I learned about multiple hedge fund strategies, whether it was equity long short, or distressed hedge funds, or merger arbitrage, or special situations, even activists. And I was the relationship manager with the activist portfolio managers, which was really fun. And those skills really added up to understanding how to run an institutional fund business, because as a small team, there were other things that we needed to do in order to run the fund. We also were involved in thinking through the pitch deck and past performance modeling and things like that. So I got a serious front row seat to allocating hundreds of millions of dollars. You said this conversation is a fun conversation. I can't tell you how fun that was.
When you were an intern, doing anything is good experience. But when you got out, now you have a full-time job there. What was your idea at that point? What did you want to do or accomplish? Or were you looking to pay rent at that point?
No, I wanted to be an investment professional and I could have paid 3 rents. I made more money than my parents made when I exited college. That was great. It kind of provided a little bit of a cushion for the future. But I wanted to be an investment professional. What I didn't know at that time is that I wanted to be a fund manager, that waking up every single day as a fund manager is a raison d'etre for me. And it gives me energy to even say that out loud. And so that I didn't know, but I'll tell you, the founder of Entrust, Greg Heimowitz, he's a lawyer by training, worked in law for a year, quit, went into banking, more on the private wealth side, and built a book of business. He was very relational and he was an entrepreneurial genius. And everything I do now is an extension of what I learned from him.
You were working on a new fund. This was a fund of fund?
This was a fund of funds, and there was an associated hedge fund at the firm. So it's kind of started as hedge fund, and then they started building a fund of funds.
Right. And so is this thematic? Was it absolute return? What was it?
It was diversified.
So that means you can do anything.
Yes, with limits. So, for example, we didn't invest in global macro. We didn't invest in biotech. We didn't invest in what I would call binary event outcome investment opportunities. We didn't do too much international investing. It was very relational. Who the principals knew, and strong relationships where they knew they could have transparency, which drives risk management all day long. We saw the market cycles, right? We knew we were a phone call number 1 or 2, which was great because that's really important when you're managing institutional capital. And then we also got to know other managers that added a lot of value. But I'm very proud to say no exposure to Madoff. And that was also a really important learning for me to understand why we were not exposed to the big hedge fund fraud. And many other institutional investors were.
Were you an analyst the whole time, or did you ultimately become a portfolio manager and live and die by your returns?
Yeah, I became a VP. Nobody in the team was responsible for their own portfolio returns, but I was a relationship manager where I was very close with international long, short, and activist managers, which led me to understand a different type of investing, which is the kind of more active approach that is the private markets VC approach.
Your time at Entrust crossed this beautiful period of 2008 and the financial crisis and the Bernie Madoff mess and everything else on top of that, which an awful lot of us have lived through. So despite having achieved significant professional and financial success in your life at that point, you experienced somewhat of an internal shift. I think this is something many ambitious people can relate to at one time or another. But was this a gradual realization that something was missing, or was there a specific moment when you thought, I need to use these skills I've developed for something that aligns more with something deep in me? Tell me what was going on inside of you at that point.
Number one, my moral compass was pointing in a different direction. And I actually think, interestingly, the firm's moral compass was pointing in the same direction as mine. When it came to the big short trade, and I wrote about this in my book, we sat around predicting the fall of Lehman as a smaller, maybe not with the principal, but as a smaller investment team. I'll never forget that day. We heard the pitch for the big short trade. We came down the elevator. We went to the office. We had this little kind of quad. We turned our chairs around and we said, who's going to hold this bag? That shook my sense of security in our financial market. And so I thought, if there's no sense of security here, then why am I taking safe bets? What risks could I be taking that could be much more purpose-driven for me as an individual? Because making money for pension funds is actually very purpose-driven. And we were doing that. And there was some interaction with the Taft-Hartley pension funds that we managed money for, and understanding who was benefiting in the end from our investment decisions. Again, because of my upbringing, I think I had a little bit of a different programming. And so I think the second part, though, was, and I say this lightly because I really did receive a lot of knowledge, but as a young female, there was a little bit of mentorship lacking for me. And I genuinely didn't know where to go from there. Felt quite stuck because I was young, I was ambitious, I was successful, but we all know that those three things do not add up to fulfillment or happiness. And I happened to meet my husband around that time, and we just decided to combine our lives. He was actually living in Zurich. I made a pivot. You know, it's interesting because I'll speak honestly, Scott, to tell you, building a fund business is hard. Building a fund business where you're also not investing in midtown-based hedge funds is even harder. And the journey is not as linear as it was at Entrust. I don't also have as much resource behind me as the team at Entrust did. But I never look back and say, I could have earned X or my opportunity cost was X. I've literally never said that to myself in my head. And so this is all worth it because I get to keep what I thought was really fun about working at Entrust, and I get to build on some of the other elements that I love about work, which are connection with investors, connection with founders, and then solving really interesting problems, not just looking for a good trade.
In 2009, during the worst financial crisis in recent history, you decided to leave Wall Street to start something completely new, and that was to co-found the Beyond Capital Fund. At that point in time, most people were protecting what they had. What made you take that massive risk? Walk me through that decision-making process.
I think it was beneficial that it was my first financial crisis. So I didn't really understand what it meant. My husband was the general counsel of Gate Gourmet. We were, again, combining our lives. And so I knew that I was in a secure position. I just knew it was the right moment. That's what happened for me. I read the right books at the right time, heard the right things. I met the right people at the right time. I leveraged my existing relationships and met more people. There was just so much moving in my direction that pointed me towards emerging markets and a different way of investing. The reality is public markets are not available. So had I been able to use that as a tool, maybe I would have, but private market investing is the way to gain access to, I would say, aligned emerging market investing. In public markets, you have way less control over what you're investing in. Everything pointed me in this direction, and I just moved in that direction. And if anything, having capital, a little bit of capital, or at least a safety net from my own career, obviously my husband was employed, was wind in my sails.
So you left Entrust and you co-founded Beyond Capital Fund. But when you did that, you made a very strategic decision to structure it as a 501c3 nonprofit organization rather than a traditional VC fund. For non-U.S. listeners, that's U.S. tax code mumbo jumbo for a not-for-profit organization where donations are tax deductible. So walk me through that reasoning that you had to set up first as a nonprofit and how you use that structure to prove that you could achieve financial returns and invest your values. And this was all at a time when impact investing wasn't really a recognized asset class. And who are your investors? But I guess they weren't really investors. They were technically donors. Am I right about that? Take me through that.
I can walk into any room and right now and blow people's minds. These numbers are not different than they were in the past. They're just a little bit more acknowledged that 1 in every 4 people on this planet in 2050 will be African, including 70% of the world's youth. 300 million Indians will enter the consumer class in the next 10 years, more than any other country. So now I think we understand A, the opportunities, but B, the challenges of emerging markets and how the world is inextricably connected and cannot be unconnected, regardless of what powers that be are looking to disconnect. Doing that 15 years ago, we made our first investment in 2011. So it's a 14-year track record. I started the work in 2009. I would have been laughed out of the room. I cleverly decided to set up our investment strategy as a nonprofit, knowing that there were individuals who were curious about social entrepreneurship, which is what we used to call the types of things we invested in. But I did it almost as like a Trojan horse because we never changed the way that we invested because even though we were a nonprofit, my IRS application was approved on being able to invest equity into social entrepreneurs that have a strong impact. I never had any restriction. We've always behaved like a VC. We've never given a grant. The Trojan horse bit was put it in a structure that's more palatable, build the track record, which is top quintile, 10 markups, 0.03% loss ratio, and impact on 110 million people today within Fund 1, which was the nonprofit. And we put it in the nonprofit to incubate. Now, I'm going to say something to you that I've never said to anybody else publicly. And I think it was a mistake because it kept us too small. I think it was the right thing to do, but I think it was a little bit of a mistake in the growth of the firm. But, I was a 25-year-old woman and I could list to you, and I wouldn't, what some men have said to me in my life about right? And so
Well,
I had no choice,
this
right?
isn't family entertainment, but
I actually mean more like, this is your hobby, or you should do this as a charity, right? So I had no choice but to do what we did. But I think we had been raising for-profit capital probably 5 years afterwards, after starting the first Evergreen Fund, we would now be over 100 million. But it's hard to go back in time.
should have, could have. I guess back then, was this also about the time when the Gates Foundation was popularizing performance philanthropy? And what was the pitch at that point? And who were the investor donors? And were they in on the jig, or did they think they were donating?
The pitch was, you give us money and it lives into the future. We invest it, we get capital back. We have 3 exits. Again, it's not a SEC registered entity, so I can share. We have a 27% IRR on our exits. So we recycle that back into the portfolio, and your money recycles over time. Yes, you get a tax write-off, but you get the feel-good factor of knowing that this is not just a one and done. Our donors were largely high net worth individuals, a few family foundations, and that was pretty much it.
All U.S.?
We have a Swiss association, actually. My husband ran Gay Gourmet on the management team. I was living in Zurich, so I had a lot of strong Swiss connections. And so we have a Swiss association. So we did have some meaningful Swiss donors as well. That was the pitch. What I realized when we started to raise venture funding, which was in 2019, was that people who would give us $1,000 or $5,000 or even $50,000 would write $500,000 checks to the venture fund. So there was just a different way of motivating the investor when they had the possibility of getting their capital back. But I think we did an excellent job. Again, we picked winners. We picked great founders. We shared stories. We communicated well. And we built the track record. And we're actually still executing on that track record because of the evergreen nature of the fund. We do have some exits coming up in late 2025, early 2026.
But then do you reinvest that? Because theoretically, if I understand this right, they were donating money. So they never expected a return of capital. And when I say, were they in on the jig, I mean, you had this idea, let me set this up as a foundation or a not-for-profit, but I'm going to show them that you'll never have to write another check because I'm going to measure results. I'm going to hold people accountable, and we're going to generate a return so that we're going to be able to keep investing even if you should never donate again. Were they in on that or not? Because at that point in time, impact investing was not really a thing, but there was this idea that philanthropy, you write a check and you kiss control goodbye and you never know what happens. And that was the time when I think Gates was saying, okay, this is performance philanthropy. I don't know that I hear that term too much lately, but it was popularized, I think, in the early aughts. Is that how it went? Or were they saying, okay, we're going to hold you accountable to hold them accountable?
Yeah, I mean, they were in on it, and our donors were very in on it. And many of them actually co-invested it with us in deals. And they got to see the depth of the due diligence that we did. They understood that there was a real possibility of getting our capital back and recycling it into new opportunities. They were excited by that. That was a value proposition. But the reason I also said I think it was a mistake is because that was a confusing narrative in philanthropy. The philanthropy narrative has nothing to do with getting your money back, right? It was a confusing narrative, not for our donors, because we brought people along who were probably more like professionals or in business who got it. They understood what business could do, business as a force for good. But it was a confusing narrative for the big philanthropy to see where we fit. They were like, we're not investing and you're investing. So because you're not giving this money away, we're not interested to work with you. So it did become a little bit of a fundraising pain point. But I'll tell you one thing. When you give seed capital to a small company and they are able to mobilize a tremendous amount of capital afterwards, I think it was about 16x at one point, and the number has gone up from there, what we put into them. You create lasting impact that is almost its own flywheel of impact. And that is why today that fund indirectly impacts 83 million people. And of course, we measure much deeper than that. But the indirect impact is products and services within need to haves provided to households and how many people are impacted by that product or service. That achieved our goal in and of itself. I think I said 83 million. That was our last quarter number. It's 110 million now. I never expected to have an impact on over 100 million lives.
So the idea to do that was you didn't have confidence you could go out and raise an impact fund with no real portfolio management experience. Is that it?
I had portfolio management experience. The idea to set up the nonprofit was I didn't believe that investors understood the markets enough to put their for-profit capital into them.
You just didn't feel like you would be able to raise the fund if you went, we're an impact fund. You're just not going to get any takers at that point.
Humans are intrinsically motivated by a number of things. And one of them is what's in it for me. And while the what's in it for me and the feel good factor of your tax write-off is good enough, it has a limit. The what's in it for me of a venture fund is we've got you on the return side. We're returns driven and we're going to measure impact. If you decide to see that impact and returns in our markets are causal, then you will 100% feel good about this investment because you'll get your money back and you'll have impact.
Still, at that point in time, yes, you had portfolio management experience, but working on fund of fund is quite different than doing a VC private capital fund in impact. You didn't have a track record really you could point to on
Correct.
that. Now, that's an innovative concept. Starting any new venture is challenging, but doing this during the financial crisis had to be a nightmare. Paint the picture. How did you build Beyond Capital Fund from zero? And how did you find your first investments? And how did you attract your initial investor donors and prove that this model could actually work?
I bootstrapped the firm on my own. I put in, let's just say, enough money to own another very nice house in Los Angeles for a down payment for a mortgage into the first fund in terms of operating costs. My husband and I kind of viewed this as our own philanthropy. We covered the operating costs for the first 7 years, and then we made it a little bit more formal as we grew. How do we find our first deals? I had a good friend who worked at Ashoka. And so we kind of worked our way through the Ashoka network. We made a first pilot investment through the fund. My husband and I put personal capital into that investment, and it actually failed. So that's one of two companies that I've invested in over 50 deals in my career that has failed. The other one was in the dead heat of COVID in April of 2020. It was a rough go for that business because they just lost liquidity very quickly when an investor pulled out. But to circle back, we started with Ashoka, and then we started to realize that we couldn't do this alone. So I recruited typically post MBAs, but also occasionally MBAs from top schools in the US to be what we call due diligence committee members. And it was a year-long fellowship where you got to bring forth deal flow. And by that point, we had a more diversified sourcing platform. Bring forth deal flow, review the deal flow, due diligence, recommend an investment to the board at that time, not investment committee, for investment. And what's interesting is my business partner now was one of our original due diligence committee members. And he's now full-time a partner at Beyond Capital Ventures. And so the recruiting platform was a way to think differently about the future and the people and the network that we wanted to build. In fact, we have an LP who is a due diligence committee member as well. But that was a start, and it was a way for us to have low-cost talent, but high-quality talent who was also really curious about the space.
How did you find your first donor investors?
Because we were bootstrapping, we basically went to people and said, listen, we're paying for the operating expenditure. So all your money will go to investments. So you have entire full charitable purpose here. Are you interested? And we got a lot of yeses despite the financial crisis. My husband does work in the restructuring space. So when things go south, his career goes north. And so we did have a lot of friends in that space who contributed capital. And then we just continued to tell the story and raised money from there. We raised $2.5 million over a 10-year period, which again is why I believe that the for-profit model was probably more suitable for us at one point. But I did not make the move to the for-profit model until I stepped off a stage in Brussels in 2019. And I had already had my second child, even though I was doing this all full time. And I heard somebody come up to me and say, can I invest in you? Because before then, I was not getting the market signal. And I was scanning for it day in and day out. And I heard somebody say, how do we invest? And I said, okay, we're ready. And we started creating the deck, and we were out to market January 27, 2020.
That was great timing. Before we get into that, 2019, you founded The Conscious Investor as a weekly magazine. Explain what that is and why did you do that on top of everything else you're doing?
Yeah, that was a beautiful project. I'm very relational and I was meeting great people, but I'm also very efficient and I move really fast. And you guys should connect because maybe you'll have something in common. Introduction, I find very challenging because it leaves me with a sense of emptiness and I don't know what to do with the connection. And I was very inspired with what Gwyneth Paltrow had created at Goop. I was featured on the website 3 times and I wanted to create a Goop of sorts for conscious investing. And I happened to work with one of the Goop editors on a freelance basis. And she and I ran the magazine together until COVID hit. And it was more of a personal decision, bandwidth wise, with all of the difficult things that happened in the pandemic for families to not focus my time. Believe it or not, Scott, it wasn't a lot of my time that was required. I was funding it myself and I designed the website myself. My mother was a graphic designer. Give me a day or two and I could spin up a really nice website. But what I love about the website was it still lives now. And the stories that we told, whether they were interviews or book reviews or B Corp certified planners or B Corp investment advisors and just lists of places that people could go to think about and learn about conscious investing now still exists today. And so the goal is really to provide a different source of media that was not the who's who or the daily news like some other sources like Impact Alpha provide, but more of a kind of journalism centered approach to who is actually doing this work, what are they doing, and what's their purpose.
So it stopped during COVID?
I've just personally decided to stop funding. The pandemic was challenging.
For everybody. I think you just said you founded BCV in 2020, but I thought it was 2021, but somewhere around there, somewhere during this pandemic, you decided, okay, now it's like you founded the fund and during the financial recession and now we're in COVID. So you've mentioned many times that you think you should have done it earlier. I think it sounds like this one person coming up to you and saying, I want to invest with you might have been the moment that you decided. But was this always the plan? And maybe you could just give me the big picture of Beyond Capital Ventures today.
Scott, the plan was always to be big and to have a big impact. And what I said earlier is highly accurate that returns and impact is causal from business growth and returns in emerging markets. If you want it to be, of course, you can invest in things that don't have impact. That's a choice, right? But the bigger my companies grow, the more impact they have. And so that was really exciting to me. I also, again, am a New Yorker. I worked in traditional finance. I love money. Money is an incredible tool. It's a beautiful and elegant tool when used with a little bit of hint of purpose in mind or a lot. And so I always wanted to professionally manage money and I jumped at the opportunity. So yes, while the Fund 2 is a 2021 vintage, we started raising on January 27th, 2020. You've never heard anybody draw that thread between GFC and COVID and taking a big risk around each one of those points in time.
Timing is everything.
Yeah. I mean, I actually think COVID helped me raise the fund because there were investors that I hadn't met in person until years later because it was socially acceptable to do everything on Zoom. And I didn't have to travel everywhere. And I was able to be a little bit, I would say, more resourceful with my time. On the other side of that was Zoom fatigue, which I think is definitely a real thing. Now with Fund 2, started Fund 3 through 4 SPVs and a debt fund. So we also are a private credit investor. As of 2024, we manage 25 million. And we are in the process of scaling significantly from here through multiple raises on the credit and venture side. When it comes to what we invest in, while our original focus was always basic needs, focused on aspiring consumers, lower income consumers at the first fund. When we started to raise the for-profit venture fund, we adjusted our approach to be more focused on the aspirational consumer exclusively to have investable opportunities that still, again, had this causal or very strong impact. And again, this Fund 2 itself is reaching 83 million people today. So we've been able to prove that in only 4 years of the fund life. But we invest in health tech, fintech, ag tech, and mobility. We don't believe that tech, end-to-end tech, is the right strategy for the two emerging markets where we invest, which are India and deal origination in East Africa, with companies scaling across the entire African continent. But the tech underpinning is super critical because our companies are resourceful and their job is to disrupt and leapfrog. And without tech and AI being about an platform underpinning of about 80% of our portfolio companies and probably growing, without tech and AI, it's impossible to disrupt and leapfrog in the markets where we invest. The physical infrastructure, the political infrastructure, while we see economic liberalization, while we see maturing capital stack, while we see depth of capital market increasing, it needs to be coupled with some element of tech. So typically what we invest in are seed to Series A plus businesses in those sectors that are serving aspirational consumers with what we call the need to haves. And a couple examples are East Africa's leading e-mobility business, which not only manufactures the bikes, owns the batteries, but is the battery swap network in Nairobi, Kenya, and Kigali, Rwanda, and is expanding within Kenya and Rwanda as a company. So basically, majority of the revenue of that business comes from battery swaps. We're also invested in a company called Clinique. Clinique is a health clinic chain, not different than, for the American mind, One Medical Group. They have the subscription model, but then they add on insurance. And the insurance sales are really the value add of the business. They offer insurance that is better priced and higher quality than other providers. And they're able to really capture their patient long term as a result of that insurance component.
You said 25 million. Is that the total AUM of both funds, or is that the new fund?
So that's the total AUM of our venture fund, 4 SPVs, and a smaller debt fund. In the way that we incubated Fund 1, we just incubated a debt fund. It's where we lend exclusively to our venture fund portfolio companies. Yeah, so that's our total AUM.
You started BCV and BCF. You could have gone anywhere. You had a white piece of paper, but you chose to focus specifically on India and East Africa. Why did you select these two regions? Make the case for me. What makes them particularly attractive for impact investing? And what are the advantages that you have in these markets that other international investors lack or are overlooking?
What's the advantage of these markets? Number one, basis of the British legal system. Number two, mobile prevalence. As you know, mobile payments were born in East Africa. People were transacting with their mobile phones maybe a decade before we had Venmo in the US. And then finally, the prevalence of English was also really important to us. I don't speak Spanish. I do speak French, but it was really combining two markets that were highly complementary. And so what we started to realize was, while India is probably 10 years behind the US, Africa with tech enablement is catching up, and it's about 5 years behind India. The aspirational consumer in both markets, whether it's East Africa or India, is requiring very similar products and services and demanding that and paying for it. We see synergies not only across portfolio companies that, some innovations born in India are asking us for connections to scale to portfolio companies to scale into Africa, but the majority of the world's growth will occur in the Western Indian Ocean region between now and 2050. And that is inclusive of East Africa and India. That trend for us was undeniable. And when it comes down, we will never be able to have this trend again. In our lifetimes, this trend will not exist. So I think this is as urgent as AI as an investment opportunity. But what are we getting that other investors don't? We are getting significantly better valuations than investors who are not investing in these markets. So, for example, in Fund 2, the average entry valuation of all of our portfolio companies was $18.5 million. It was 38 million in the US for Series A rounds on average. We basically were able to invest at half the US Series A valuation, and in very similar companies that have similar enablers, because enablement is democratized in today's world with technology. That's really important. What are we doing that other investors in our space are not? Our portfolio management repeatable process is proprietary and is time tested. And goes above and beyond. We sit on 70% of the boards. We pour hours and value add into our portfolio companies. We help them raise money. Our companies have raised in a smaller fund $80 million after we invested in them. We offer them debt, and every dollar of debt we give unlocks $9.8 of almost $10 of revenue. We also give our founders a stake in our fund, and this all results in a 93% net promoter score. So we've substantiated that our existence matters to the people that we invest in.
So you've built beyond capital ventures on what you have called a contrarian thesis, that you challenge the high risk, high return philosophy of traditional VC. What you just explained is that your portfolio in the emerging markets is actually less risky than a Silicon Valley VC's portfolio. So that's a bold statement. Maybe you could just walk me through a little more of the logic behind that and explain your theory of change and the fundamental problems that you're trying to solve.
So the theory of change is enabling disruption in need to haves. It's providing access to what's not available, good quality healthcare, good quality medical devices, medical consumables, in other words, feminine sanitation that's not available in rural areas, HIV drugs that are not available or have stockouts. That's all in the healthcare space, but I could tell you in fintech, it's goal-based investment savings in high inflation environments, access to health insurance. The list goes on. That is our theory of change, is closing the access gap. Our theory of change is also closing the capital gap, which is why we are, I call multi-asset, but multi-strategy firm with venture and debt. Because if you were to wake me up and say, Eva, what is your theory of change? I would say building capital markets where we invest, because that is what will flow through to tremendous impact and wealth creation and economic development. Those are the two areas that we're very focused on.
You said that your portfolio in emerging markets is less risky than a Silicon Valley VC. And I think that relates to your focus on need to have sectors. Maybe you can answer that.
I love this question. I know that our portfolio is less risky, and here's why. Investing with a power law approach, aka spray and pray, is inherently risky. It is a model where you bank on the loss of companies, expecting for the winners to cover all the losses. That is not how we invest. We invest in a much more concentrated portfolio of investments where we get to know our investments better than your Silicon Valley VC investors. And we have the opportunity to, because our environments are slightly less competitive, or the door opens to us because of our track record in India or the people that are on our investment committee and things like that. We know our investments, I would say, better than your average VC. And then secondly, the portfolio management approach actually works and it is differentiated. I know every VC says they do this stuff. I can tell you that no other VC where we invest does any of the things that we do. And this is from the horse's mouth, from the founder's mouth. Wow, we really appreciate that you showed up for us in this tough moment. We really appreciate that you scrambled to get executive comp consulting when we were told by the follow-on investor that our stake was too low and we freaked out because we wanted to raise the next round. We really appreciate that you provided us with debt capital when that government backed out of the investment and we didn't have access to the capital that we needed to grow. And you started underwriting in 3 days. All those things add up. So I think the secret sauce is the portfolio management approach, which de-risks the portfolio. And therefore, that's why we've had a 0.3% loss ratio.
So let me see if I can summarize it from a different way. Is the underlying demographic dynamics of the regions you're focused on is extremely high growth and an emerging middle, so to speak. And then your investment focus is specifically on need to have sectors, healthcare, financial services, and climate resilience in both of these markets, India and East Africa. Since the demographic underlying this is there, the emerging middle is growing at such a high rate, and these are need to have sectors, it's way less risk than in the developed markets where you don't have the same potential.
Yes and no. While that tracks and that resonates, the risk is in how we manage the investments. We still have to pick the winners, just like Andreessen Horowitz. We still have to have a sound operating model. And for us, the operating model is due diligence and deal selection. It's source better, invest better, add value, right? And so while the sectors are more resilient, if we don't do the right investment selection, it's useless. I think why I believe our strategy is less risky is because we have the opportunity to get to know our portfolio companies better. We manage our portfolio in a much more careful way than traditional VC. And we're not looking for one unicorn to return the entire fund and move on and wish all the other founders good luck with the rest of their careers or starting their next companies. I know from a very large VC that, and they are one of the top names, they don't get to know the people behind their investments. They are sent the deal and they're like, are you in or are you out? Because your competitor is going to eat this up tomorrow. And you have 24 hours to decide. Does that lead to better outcomes? I don't think so. We know that VC returns have fallen flat, not in recent years, but like over past vintages. And the final thing I would say is when any asset class has an incredible inflow of capital and there's too much money to allocate, typically returns revert to average, right? And you know that in your work. And I think one of the main reasons is that means that under experienced people are making decisions. In our small firm, experienced people who have worked together for 13 years are making decisions. And I think that drives better decision making and reduces risk. That's why I think it's less risky to invest where we do, but it is our operating model that supports it.
You have a dual fund strategy. You operate both the Beyond Capital Ventures Fund 3, which is equity investments, and the BCV Debt Opportunities Fund. Explain how this dual fund strategy structure uniquely positions you to support early stage companies in the emerging markets where access to traditional financing is often limited.
Venture is kind of the startup tool. It helps get the business off the ground, but no company in emerging markets in our space that is typically distributing goods and services or even providing access to finance can operate without working capital. In fintech, that's called on-lending capital. While I was responding to a need amongst our portfolio companies, and again, falling in line with this mission of deepening capital markets, setting up our debt opportunities fund was also actually in line with the market trend, Scott, not in contrast with the market trend of 2023 being the year of private credit. Interest rates have been quite high, so private credit is having the time of its life. And what I realized was our companies need capital too. And we've known, and we can underwrite investments in businesses that we've known for an average of 2.7 years because we will lend only to our venture fund portfolio companies into US holding companies because our African businesses are all US holding companies. And we have one Indian company that we were able to invest through a US subsidiary. So we de-risk the structure risk, the jurisdiction risk. We can use the best practices of restructuring, which we know quite well and have expertise in our LP base around. And we respond to a demand for debt capital amongst our portfolio companies, desire to invest in private credit in a 3-year fund life versus a 10-year fund life amongst our LP base. It was a win-win. But again, the core mission was, how are we contributing to the growth and the depth of capital markets? And one thing that is definitely required and is an enabler, and we know this in the US, is credit. And so our ability to provide that in, I would say, flexible just means in an agile way, really has proved the goal. So that the Debt Opportunities Fund has made now 12 loans to 9 portfolio companies, no NPLs, no late payments. We know these businesses really well, no visibility towards impairment. And we've got less than half the fund life left. And the day that I return all the capital will be a pretty momentous day for me as a VC because I've actually not had that opportunity before.
One of the innovative features that I've found that you've developed is something you call the Conscious Leadership Questionnaire. And I think it's a 30-question survey that you use in pre-investment due diligence. tell me what this is and tell me about how you develop the tool and what you're really looking for when you're evaluating founders.
When we pivoted to for-profit venture model and wanted to really codify what drove impact and returns, I was in the third season of my podcast called the Beyond Capital Podcast. And I was interviewing purpose-driven leaders who were running big, medium to large size businesses, C-suite entrepreneurs. And the fundamental question was, what drives purpose and success in your business? And the answer to that question was thinking about all stakeholders. It wasn't a clear answer, but that was the broad spectrum of what we learned in interviewing 100 purpose-driven leaders in our show. And that was a big aha moment for me, because I realized that our secret sauce to impact being baked into business models, which is what we wanted to achieve, again, to create sustainable businesses that could grow and exit and give investors returns back. We also give a percentage of the profit share, as I mentioned, to our founders. So they also earn when we do well in our fund. To create that required a deeper awareness of what conscious leadership actually was. And the way we define it is above the line thinking. So above the line thinking is seeing possibility. It's seeing abundance, being abundant. And it's also stakeholder awareness. So being aware that when I run a company, I do, right? Even though I'm a fund manager, I run a company. My stakeholders are not just my investors, my LPs, my shareholders. They include my founders, effectively my kind of customer who does the hard work to produce the return. They include my community who can learn a lot from the things that we do differently. They include the government, or I'm thinking more in the case of individual companies now, the government, the environment, the climate, as well as the employees. And of course, my employees are included in my stakeholder group too. And this framework is what helps leaders make decisions that are impact driven and also do not trade off commercial return or commercial outcomes. And so we've put together a 38 to 40 question questionnaire. Every founder needs to complete it before we invest. And we're in the process of algorithmically understanding some of the trends around conscious leadership. We also do behavioral assessments, more to understand who the right relationship manager is for any portfolio company at any given time when we invest.
You said that you want leaders who are in love with the problem, not the solution. What do you mean by that in practice? And does this questionnaire help you identify those qualities?
We ask about working on yourself. How do you cultivate leadership? How do you cultivate your mission amongst your employees? Why it's so important to us that we're investing in founders who are in love with the problem and not the solution is being in love with the solution it's almost easier, but it gets really tricky and almost harder on the downside. Because if you die with your solution, you're done. You're right off. But if you're so in love with the problem, continue the thread of ampersand that East Africa's leading e-mobility business. If you're so in love with the problem of providing an electric vehicle at a lower cost to the driver, who is typically a gig economy worker doing rideshare or deliveries or courier, earning their whole livelihood that way, you will do everything you can to make sure that they have access to your bikes at a lower cost than petrol or competitors. And that access will be easy and thus scalable. And Ampersand has done an excellent job because they started out as a bike manufacturer. And then they realized, hey, we got to take control of this battery situation because we need to make sure that we understand the battery power, the performance of the battery, and also where the batteries are, because this is actually a separate asset that can be separated from the bike. And then the company realized that homes don't have plugins like my EV is plugged in downstairs right now in my garage in East Africa. So how are riders actually going to achieve the goal of using this vehicle all day long? Because if not, sales will fall pretty quickly. They set up a partnership with Total Energies because 60% of our companies have partnerships with very well-known corporates, or they are also an investor in their companies. And Total pays for the CapEx for the battery swap stations in Total petrol stations across Nairobi and Kigali. And so that is being in love with the problem. Similarly, I'm so in love with the problem of deepening capital markets and providing access to capital that enables access to need to house that I set up a credit fund. I can tell you that many of my team members were rolling their eyes because it was like, we've never done this before. We have to create an underwriting model. We have to create a credit scoring model. We have to create a credit policy. We have to go down this road that we basically create a whole new business line. But it's been incredible for us.
We've been talking a lot about the investments you've been making. If you could briefly walk me through your end-to-end investment process so we can understand that from start to finish, from how do you define your investment universe or your source deal flow through your screening process, both financial and non-financial screens, and then how do you structure your investments, and then importantly, how you define your exit strategy if you do so at the front end.
We source our investments from over 150 sourcing and co-investment partners. There's specific criteria that they need to meet. They need to be seed stage, not pre-seed, post-revenue, have product market fit. And then there are specific qualities that we're looking for. Again, within our sectors, there are certain sectors that we don't invest in, even biotech, for example, or biofuels, even though we do mobility and healthcare. Our sourcing process is also very ground up. You'll never find me get a deal from the US or Europe, which is why sometimes I find that the random introductions a little complicated because I don't want deal flow from the US or Europe. I want deal flow from where we invest in our office. And I would rather the principal who runs our Nairobi office to be filling up his water bottle and meet a founder than us meet them through some other channel. That's our sourcing, and screening is a kind of a basic process for us where we have very templated ways of assessing different parts of the business. So it's typically market, model, mission on the point of impact, management, metrics, and what's missing. Those are the 6 M's that help us with the initial screening. We also do have a conscious leadership scoring in the initial screening. So we score on 1 to 5 on the company's focus on all 5 stakeholder areas as well. And we discuss that. And then we move through multiple rounds of due diligence, typically substantiating all of those 6 M's that I just mentioned. So from there, we decide to go to investment committee. Our investment committee is comprised of local experts, individuals who have either been VCs or been advisors to investors in the markets where we invest that are more independent and independently minded. And there are some non-independents on the team that also join these conversations. And the deal lead presents the investment opportunity to the investment committee, and then we approve. And that's when we obviously have an idea of what structuring is going to be. We've led 70% of the rounds across the firm. Sometimes that means that we put the deal structure into place. When we lead, we put the deal structure into place, but sometimes it also means that when we're not leading, we're given a kind of set of terms that we negotiate and we accept. You said, what type of investing are you making? So on the equity side, we're typically in Africa because we're investing in US holding companies doing safes or in rare occasions, convertible notes. A safe is a simple agreement for future equity. And a convertible note is effectively an equity-like instrument or a debt-like instrument that converts to equity with an interest rate and a discount attached to it. They're very similar, but convert notes, I would say, are a little bit less risky because they're treated like debt. So you have this kind of higher in the capital stack position until they convert. And then in India, we use equivalent structures, typically compulsory convertible debentures, occasionally convertible notes, occasionally direct equity. There are different ways that we invest in India, and we have the right advisors to help us do that. So that's kind of our process, but it doesn't end there. And you asked about exit. So then we move into post-investment. Post-investment is, how may we serve you as our portfolio company? And in addition to the areas I already mentioned, we also have founders groups called Forum. We borrowed this concept from YPO, where our founders are meeting with their peers in a confidential space. So they have access to a network. In addition to connecting them to capital, we will think about strategics on their cap tables or as investors in their companies. And I already mentioned that we have a pretty strong, I would say, baked in acquirer in many of our businesses. In addition to that, we view secondary sales, since we do invest quite early, and IPOs in India as highly viable routes to invest. I don't know if there's an actual bell at the Indian stock exchange, but if it was NYSE, I will be ringing the bell for one or two of our portfolio companies in the next 5 years.
What makes your process different from what one might describe traditional VCs?
We are much deeper because we invest in fewer companies in our due diligence. In Fund 2, we invested in 15 companies. We had one spinoff. We have 16 businesses. Typical venture funds have over 30 businesses. So our decision-making process can be a little slower, but it adds up to success in the relationship later on. What else makes us different is the fact that vis-a-vis global investors, nobody else has deal flow like we do. Literally nobody else in the city of Los Angeles has the deal flow that I do. That's what's unique. And that comes from, again, we don't believe in following the herd. If we want to go right back to Bernie Madoff, we do not believe in following the herd, which is why it is nonsensical that somebody would refer a deal to me in Los Angeles and I would invest in it in Africa. We are looking for idiosyncratic deal flow, undervalued opportunities, and that is typically flowing through our network out of our office in Nairobi.
You've also referred to something I want to pull out as the Equitable venture structure, which is something that you do, which I think is pioneering, and you share a portion of your fund's profits with your portfolio founders. This is radical in the VC world. What was the genesis of this innovation? Give me a high-level overview of how it works and what's been the most surprising result from the implementation of this.
So we carve out 10% of the general partner profit share, and we give that to all the founders in the portfolio. In Fund 2 is when they met specific milestones. Either we reinvested in them or they met specific milestones, and they also received a bonus for gender positive policies and above average number of females on management teams and in leadership positions at the business. In Fund 3, we're moving away from specific metrics, and only if the company raises its next round will we then trigger vesting of their carry. And the reason we did that was because our due diligence includes very extensive impact. We talked about this a little bit earlier, but we do as extensive of impact due diligence as we do financial due diligence, which is typically just understanding where is the company having impact now. We tier. So now, next 6 months, and then like next 12 months to 18 months, where are they going in terms of impact? So we already know and have assessed the impact of the business. But what is the most surprising outcome? It really has been that having ownership in our firm has created community. And in creating community, we've built a portfolio that serves itself. I've alluded to this earlier. We have portfolio companies in India looking to scale into Africa, and those founders are calling us, or they're calling the companies directly and just saying, hey, we're interested in your market. How can we work together?
Did you say you're moving away from this gender smart criteria?
We're not moving away from gender smart criteria as a firm. We're actually the only 2X gender lens investment certified venture fund in the world. But we are moving away from the bonus that we give founders in earning carry in our fund, because we're already assessing for gender and climate metrics and also jobs and livelihoods in our due diligence process. It's an operating model challenge more than anything else. It's nice to have the criteria, the ownership, the vesting linked to specific milestones. Like it's a carrot. What ended up happening in a small firm is it was operationally heavy, and we decided that it was best for us to grant carry. And if companies raise next rounds and they're validated by next round of investors, we'll unlock that carry for them. They've already earned it by getting through our due diligence.
You've just walked us through your investment strategy. Could you just walk me through an example of a portfolio company? You've mentioned ampersand before. If you could walk through how it demonstrates your approach. How did you identify the opportunity? How you made your assessment, how they were suitable, and then how you made the investment decision, and what was the impact and financial results you achieved with the investment?
We invested in somewhat a non-traditional model in the healthcare space called CarePoint. CarePoint is a roll-up of healthcare across the African continent, healthcare facilities. It's not building from the ground up. It's literally acquiring and transforming assets. And we got to know the founder, honestly, because he was also an author. And I had learned about his book. He lives in Ghana, so he wouldn't have naturally come through our office, although we only invest in businesses with a material presence in East Africa or a headquarters. So he had a branch in Kenya. Our due diligence really centered around the model. We knew that access to healthcare had a very high impact. And the model itself was unique in that there is a lot of healthcare infrastructure on the continent, but it lacks a few things. It certainly lacks modernization, lacks diverse revenue streams to be able to keep the lights on, especially if it wants to serve lower class or the kind of lower income patients. And it lacks an awareness of how to grow. And so linking together branches in Ghana, Nigeria, Egypt, and Kenya allowed for this perfect connectivity to turn around all of these healthcare facilities. And our due diligence really centered around that kind of turnaround model. Of course, we looked at acquisition costs and the time to turn around and the ability for each branch to become profitable. And then how will the whole company become profitable, if at all, in the lifetime of our investment? And how will we exit? And what will the impact be? This company has an impact on hundreds of thousands of patients per year and is becoming much more efficient and providing a higher quality care than it had when it originally purchased each healthcare facility. So it's increasing quality, increasing access, but it also has the potential to grow into a Pan-African business that attracts also USD revenue. The data set of owning the largest African health outcomes database is very valuable. And that's something else we thought was useful and compelling about the investment opportunity.
Well, you've quoted some pretty impressive impact results throughout our talk. Impact measurement, of course, is one of the most challenging aspects of impact investing. You use a 3-tier reporting framework that's based on things like IRIS and IMP standards and SDGs and 2X criteria. Can you tell me in an understandable way what your 3-tier framework is and how does your approach to measuring and managing impact evolve once you've made an investment?
So the 3 tiers is really, what are you doing now? What are you doing in the kind of short term? What are you doing in the medium term? And how do we put in place metrics that help grow with the business? So we do all of the work up front. We identify what is this company's theory of change, as you asked me, and then what are the IRIS metrics, just for convenience sake, that we can align with that theory of change and ask the company to complete quarterly reporting. So in some cases, we are measuring climate impact. Let's say we're not measuring impact on children. A company may already be measuring that and then they'll report it to us anyway. But otherwise, we're creating bespoke frameworks. And often these frameworks are useful for businesses because they use them to make their ESG and impact reporting much more robust themselves. That is a critical part of how we set up our framework, is we know it will have other purposes. And once we invest, we monitor the impact and we ask questions around changes. We have discussions around impact performance. So for example, we had a company that was scaling their business model with the use of female agents as their kind of distribution platform. And they moved away from that because they started going B2B2C rather than directly B2C. And so we will modify our frameworks when businesses pivot. Again, founders being in love with the problem sometimes creates changes in the business models as well.
What differentiates Beyond Capital Ventures from other impact VCs? You've mentioned having 70% of your team physically based in your target markets of India and East Africa, and that you're a woman-led fund where 72% of your LPs are women and or people of color. So how does this create your unique value proposition?
Our LP base is largely reflective of who we are as a firm and what we stand for. And what we stand for is a different way of looking at investment opportunities. So I've mentioned deepening capital markets a lot, but I didn't really mention that where we invest, not many others are willing or have desire, which does create idiosyncratic opportunities. But we also are looking for different people, changing the face of entrepreneurship, which is why we're looking in undervalued and overlooked markets. Our LP base is reflective of that. But how we're really different than other VCs is our portfolio management approach. It's the hands-on, it's the going that extra mile, giving it our best when it comes to supporting our founders.
You've had over a decade of experience building what you call overlooked markets based on all your conversations with different international investors. What's the most important question that they never ask you, but they absolutely should be asking?
Scott, I love this question, number one. And I love it because nobody's ever asked me this. As you know, I was an institutional allocator myself. The question I never get asked is, walk me through the process of managing the portfolio and tell me why it matters and why it adds value. Everybody is focused on sourcing better and investing better. Nobody is focused on adding value. And that is exactly where everything goes right or wrong.
Eva, I've got a few rapid fire questions for you before we wrap up. Don't overthink these. Just give me whatever comes to your mind, or if nothing does, feel free to take a pass. If you had to name the one most important challenge in the impact VC investing space at this time, what would it be?
There's not enough capital. Investors need to be more willing to step up to the plate.
What do you know now about impact investing that you wish you knew in 2009 when you started Beyond Capital Fund?
I wish I had been bolder about following my intuition that there need to not be a trade-off, but I got caught in a narrative that impact and returns can't go hand in hand. And it's just not true.
You don't have to name names, but can you describe an investment that you've made that you were convinced of at the time? It ticked all your impact boxes, but in the end, it didn't turn out as expected. And what was the lesson learned from that experience?
First investment that I made personally, and that we also made in the Beyond Capital in a water and health business in India. It ticked all the boxes from the impact perspective. The business model was, I would say, innovative enough. It was set up based on research and behavioral awareness of where people go for basic necessities like water and healthcare. And it typically is the same place, but the management was wrong.
God, do I hear that. Those are what technically in the business are called tuition payments in the school of hard knocks. Now the converse of that, can you describe an investment that you had some level of skepticism about, either at the time you invested or maybe you ultimately passed on it, and in the end, it just turned out way better than you thought it ever could? And what was the lesson learned from that experience?
We made an early investment in an eye care business that was focused on cataract surgeries as well as corrective lenses, but would refer to a hospital that they ran for these surgeries. And we were able to exit that investment at a 3x return. It operated in rural India, in Assam, which is near the Himalayas. It's a much more sequestered region of India. And we did not make the investment thinking that it would be a 3x. I don't remember what we underwrote the investment to, but our returns modeling was perhaps selling the company a little bit short. And what I learned from that was simple solutions to complex problems yield the strongest results over time.
If someone wants to get into the impact VC investing space, how would you advise them to start?
First, start listening to Impact Alpha because they'll tell you everything you need to know. Listen to podcasts like this. Learn from investors that have been doing this for a long time and be bold in your ask and really bring something strong to the table, and you'll be able to enter the workforce and be able to learn as long as you're curious.
Eva, this has been fascinating for me, your journey from Wall Street to building BCV's approach to impact investing. And in many ways, the way you're reshaping how we think about risk and returns in the emerging markets, it's impressive. Before we wrap up here, tell everyone where they can learn more about all the great things you guys are doing at Beyond Capital Ventures?
You can learn about us at beyondcapitalventures.com. I'm also quite active on Instagram at Conscious Investor and on LinkedIn, where I produce articles with what we're focused on and thinking about as a firm. And you can also learn about my book at thegoodyourmoneycanddo.com as well.
What's the best way for people to reach out to you directly if someone wants to get in touch with you?
Send me a DM on LinkedIn.
Perfect. So everyone should definitely check out beyondcapitalventures.com. No fancy spelling here, just like it sounds. Check out Eva's book, The Good Your Money Can Do, which will have all the links in the show notes. And you have a podcast, right?
So we have a podcast at BCV right now called the BCV Podcast, and it's available on all podcast platforms.
All right. You didn't spend a lot of time coming up with the name.
We were differentiating it between the Beyond Capital podcast, which is the 4-season show where we've interviewed over 100 purpose-driven leaders. Simple solutions to complex problems.
There you go, in practice. Eva, thank you again for joining me today.
It was an absolute pleasure to spend this time with you. Thank you.
Thanks again. Goodbye, everybody.
You've been listening to SRI 360. If you enjoyed it, please hit the like button and subscribe to get future episodes. You can find an archive of all previous podcast interviews and more articles and information on SRI, ESG, impact investing, sustainable investing, and socially responsible investing at our website, sri360.com. If you'd like to read more lessons learned from world-class SRI investors, get a copy of Scott Arnell's book, Sustainable and Responsible Investing 360. It's a must-read for anyone wanting to know more about investing for positive social, environmental, and ethical impact, all with market financial returns. These are the stories and tactics of those leading the way as sustainable and responsible investing goes mainstream. Sustainable and Responsible Investing 360 is now available in hardcover, ebook, and audiobook format wherever books are sold.